Okay, good afternoon and welcome back everyone to our Growth Lab series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and this is going to be the first part in our four-part series on where your next trade comes from, where our focus here for the month of July is going to be on how to generate trade ideas for your trading. And to kick off this series for the month of July, we're going to be focused on how to catch a trend at the very start. And this is the foundation of the process that we spent the last month talking about with regards to how to put yourself onto the path of profitability. What is the process that you need to have in place if you want to have a shot at being profitable in your account? We talked about risk management. We talked about how to manage losers, how to manage winners, and just general mindset that you need to put yourself in. And at the core of that process is this concept of adding to winning trades. And I've talked about how mentally and psychologically that is one of the hardest things many traders who struggle with profitable trading have trouble with doing. So one of the things that we have done to try to combat how difficult that is to identify trading opportunities as early as possible so that you have the best shot at being able to follow through with that last piece that we learned last month with regards to adding to winning trades. So what I'm going to be talking about is the early breakout detector that we have here at OptionsPlay that is designed to help you find emerging leadership before the crowd does so that you can have a shot at entering a trend as early as possible and following that trend all the way through to its final target price. That's what we're going to discuss here today. Now, for those of you that are new here, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I have spent the last 19 years working with thousands of retail and institutional investors over that time to help them learn how to trade stocks, futures, options, and you might have seen me on CNBC on Fast Money, Options Action, or some of the shows providing market commentary on the markets. And like I said, this is the first step in a four-part series on where your next trade comes from, focused on where you can get the best trading ideas for your account. Now, if you're new to OptionsPlay, you can sign up for a free 14-day trial to see everything that I'm showing you here today, including the early breakout detector. You can do that by pointing your phone to that QR code here on your screen or going to the link, which I'll post into the chat window here in just 1 second. So that will give you access to the recording, the slides, and all of the tools that we'll be discussing during today's session, including the early breakout detector, which is what we're going to spend our session here today on helping you understand what that signal is and how to use the early breakout detector. Okay, so let's jump right into it because one of the things that I think most traders struggle with is not getting more ideas, but really focusing ideas on ones that align with a trading strategy that you can trust, that you can rely on, and that you can understand. And this is something that we have spent the last month focusing on. And this is something that for anyone who is brand new to OptionsPlay, I highly recommend that you go back and watch last month's session. If you don't know where to do that, you can see that on the OptionsPlay dashboard where you can see all of the previously recorded sessions from last month and go and review those sessions. But that's really where we spent a lot of time last month focusing on process, a process that you can rely on and trust to help you put you onto the path of profitability. And the last part of that process, arguably the hardest part, is the concept of once you have a winning trade, not taking profits, but actually adding more exposure. And conceptually, that might sound easy to understand, but I have found over my 19 years of trading, this is the part that most traders have a lot of trouble with doing. And that's not just because it's a difficult task to do. It is by all means, from a psychological and mental perspective, a difficult thing to wrap your heads around. But more importantly, it's baked into the ideas that you trade. And when you enter those trades, that give you the best shot at being able to follow through with that specific rule. And when I look at kind of how traders trade, a lot of traders generate essentially their ideas from what is essentially a lagging indicator. They are looking at social media, they're looking at television, they're looking at the news. And by the time a trade idea shows up amongst the crowds in those specific channels, you many times are entering a trade quite late to the game. So what you want to do is you want to try to find ideas that are as early as possible, and that's exactly what we've built is a specific scan that's designed to do exactly that. And the question from a lot of investors is to how can you find trade ideas where that emerging leadership is as early as possible and before it's obvious to everyone else. And at the core of that is going to be our early breakout detector. So what we're essentially every day, what we're scanning for is the entire market. We're looking at the entire market where we're looking at thousands of specific names. And what we're trying to find is the early movers across the market that day. We rank those by relative strength so that you can get a sense for the how early a specific a breakout is, and I'll show you some examples to help you better understand how relative strength will help you rank and sort and filter through the list of stocks. On certain days you might only have a handful of stocks in the early breakout detector like today, but other days you might find yourself where there are dozens, maybe even approaching 50, 60, 70 stocks that are in that specific category. How do you sort and rank through that? We'll walk you through the relative strength indicator to do that. And what you end up with is a small handful of early candidates. And those are some of your best trade ideas that allow you to capture a trend as early as possible and gives you the highest possibility of really following through with what is arguably the hardest rule when it comes to reaching profitability, which is the idea of adding to a winning position. And again, if adding to a winning position is a concept that's foreign to you, I highly recommend that you go back and watch our recordings from the month of July to help give you that background as to what that really means. So what we offer here is a few different ways that you can access this early breakout detector. First thing what we do is we publish a Monday and Thursday report, which is the equity research report that we put out every Monday and Thursday. It gives you an overview of the broader markets, and then it quickly gives you a deep dive into where the markets currently sit with regards to stocks that are outperforming versus stocks that are underperforming. And based on actually, the number of stocks that are outperforming versus underperforming and the type of names that are showing up in this specific view, we are giving you a comprehensive view not only of specific trade ideas, but actually the macro picture. So as you can see, we currently find ourselves in, this is the report from this morning, in a bit of a risk-off environment right now because of the makeup of what's outperforming and what's underperforming. So not only do you get individual trade ideas, you're also getting a macro view, which is really important, I think, for investors to not just have individual ideas, but also understand what is the broader picture telling us based on what's outperforming and what's underperforming. And one of the things that you'll see here is that we have very few names that are in this sort of early breakout detector range at the moment. If you actually take a look at the full board here, we only have 4 stocks that fall under early breakout. We have some that are in the building leadership. We have some in the confirm leadership space, but there are very few, and compared compared to last week, we're down 21 from last week. We're down 26 from last week. We're down 34 from last week. So a lot of symbols, a lot of sectors, a lot of themes that were in the early breakout, that were starting to build leadership, that were in the confirmed leadership, have dropped off here in the last in the last few trading sessions. At the same time, we see more and more stocks that are entering this kind of early breakdown. We certainly see that across the names. One of the things that we do see is that some of the big tech names that were in that kind of early breakdown, building weakness, confirmed laggard, have moved out of that leadership, which is, the semi names. But we have seen a lot of the industrials, consumer discretionary, even financials that have been leading the markets higher here started to show up in this early breakdown category. So what we're seeing is that a lot of the leadership that was in place, the rotation that we saw in place over the last few weeks, have started to lag behind. So, as that rotation fades, our confidence in the current rally also gets reduced a little bit here as well. And that's what's reflected in kind of the broader picture that we're seeing here. So it's really important that not only are we giving you individual trade ideas for the day, but also giving you a clear view of the broader picture as well. And that's what's really important about the early breakout detector, is that it's one small piece in a much bigger picture. As you can see, what we're showing you is kind of that bigger picture, the leadership and what's leading and what's under pressure. And when you see it as a aggregate, that's really how you can start forming a better view of the macro picture and what your outlook is from a broad market perspective. So what we offer here with the early breakout detector is the ability to not only find the early movers, rank them by relative strength, but kind of giving that broader summary of what's moving, what are the sectors, what are the themes, and that's all provided to you in that Monday and Thursday equity research report, which is what we just published here this morning. And in that report, we also highlight specific names in that early breakout detector, like the ones in the report here earlier today. Now, why are these early breakout signals so important for me to spend a whole session on walking you through? Out of that whole report, there's lots of different things that you're getting information from: the macro picture, what are the early breakouts, what are the confirmed leaders, what are the early breakdowns, what are the confirmed laggards. Why do we want to spend so much time looking at the early breakout detector? And again, it goes back to the last session that we hosted in the month of June, focused on adding to winning positions, because one of the key aspects on how to reach profitability is this concept of, once you have a profitable trade, let's say you correctly identify a bullish stock. Let's say you bought the stock at this early stage, and you bought it. Let's say the stock was at $100 when you bought it, and let's say the stock rallies from 100 to 110, for example. Where I tend to find that most traders that struggle with profitability, what they do is that if they manage to buy a stock at 100 and the stock rallies to 110, what they do is they take profits and they run. Um, and this is because everything in in the fiber of our being tells us that we should be doing that, right? And there's this saying: you can't go broke taking profits. And that is, while that's true, you can certainly severely underperform and lack profitability in your broader account if that's how you think. Because if you look at successful investors, what they do, instead of, when they buy a stock at 100 and it goes to 110, instead of taking profits and say, let me lock in my gain so I don't lose that, what they think is that, I bought the stock at 100, it's gone up to 110. That's proven my views of this stock being bullish as correct. So if there's anywhere else that I want to be placing my capital in, it's going to be in the places where I've already proven myself to be correct, or my outlook to be correct. And the concept of not just, the, the, sorry, the concept of not just buying the stock at 100 and when it reaches 110 to take profits, but to buy more at 110 and see it that if it follows through to maybe to 120, and maybe if I have another opportunity at 120 to buy some more and maybe reaches 130 with the final profit target of trying to reach 140. And this is and this is just coming from one idea, not three or four separate winning trades, because it's hard to have three, four consecutive winning trades in a row, to come up with three, four fresh ideas and be right each time. It's much easier to be right on one idea and being able to follow through with that idea than to come up with four separate winning trades each time. And the only way that you really have a shot at really following through with this is if you get in early and are able to have enough room to have maybe one, two, maybe even three additional entries before the stock essentially hits your profit target. And what I'm going to show you is that the early breakout detector with the relative strength ranking is designed to help you find stocks that perhaps have made its way down over the last 3, 6, 9, 12 months, and now is on the verge of potentially starting to make its way back, but capturing it at this very early prior point, that entry point, as opposed to many times if, let's say, you find a trade idea on social media, by the time TV's talking about it, you might be entering already right here. And then by the time the stock maybe continues to move in your direction, if you think about adding some more, you might be more inclined to see that trade get chopped out to the sideways because this trade has already made its way all the way from the bottom to near the top. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. Perfect. Okay. So the early breakout detector not only gives you the best shot of capturing ideas as early as possible, which gives you the opportunities to actually follow through with this concept of adding to your winning trades, but it also has the added effect of giving you a price target. Because if the stock has had a decline here in the past, you can use the prior highs as your potential profit target here to the upside. As I've done these sessions here over the last few months, one of the more consistent questions that I've gotten from traders is that if I follow through with this concept of adding to a winning trade, at what point do I stop? When do I stop adding to this trade? And it's a valid question, and the real answer is that there isn't a true science to it. It's much more of an art. And I tend to find that the early breakout detector is an easy way to get started with that because prior highs form your target price. Um, but if you're buying at the highs, there's really no way to say what is the target price. It's really a guess at that stage. But when you're using prior highs, though, that's a much more reasonable price target here based on that prior high. So it has an added effect of not only getting you in early as possible, which gives you that opportunity to potentially add more to that trade, but more importantly, it also gives you that profit target here to chase or to target at for the specific follow-through trades above that. Okay, so a good example of this is the GE trade. And I highlighted this trade here a couple of weeks ago, and I just want to go back to it and kind of reiterate this, right? Because we have quite a few examples of trades like this. Robinhood recently is a good example of this. GE is a good example of this, where essentially, as soon as the trade triggered that early breakout here, and if you look at the prior chart here for GE, it was a stock that was kind of range bound here for quite some time here. And as soon as it broke out here above that 310 range that it was trading in, it triggered our early breakout detector. And that's when we sold our first credit spread. And then after a few weeks later here, the stock continued to drift higher here and confirmed our views higher here. And our put credit spread collected about 50% of the profit potential here. And and it generated a new buy signal on OptionsPlay. And I'll talk through this a little bit as well as to the mechanics of adding to this specific trade. But that's really where we got a confirmation here again. It generated a new early breakout detector trade. We sold another put credit spread. And then by the time on June 12th rolled by, just a few days later, it generated another signal here. So we added even more. This time we added a debit spread. And this time the stock really took off here. And by the time it moved all the way up to 617, the stock generated another buy signal and we sold another put credit spread. So this is a good example of if you catch a trend early, you should find at least two, sometimes even three opportunities to add in fairly quick succession, right? So this is from the first trade was on May 28th. By the last trade we made, it was only on June 17th. So we're talking about essentially 3 weeks later, we were able to add three trades to that specific trade. And instead of just making $1,200 on this specific trade, this is now a $4,600 trade in this specific setup. And that was on one trade idea. So, it's a lot easier to have one potential winning trade that just kind of follows through if you catch it on early than to have four separate trades, four completely brand new trade ideas that are all right. It's much harder to do that than to have one idea that you follow through on. So this is really the concept of what the early breakout detector is trying to do, is to help you identify stocks that fit this specific characteristic as early as possible so that you have a shot at following through. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. So we're going to take a look at OptionsPlay here. We're going to spend some time on the platform, but the first thing what I want to do is show you how you can scan and rank the trade ideas. Then we'll take a look at kind of the reports, and then we'll talk a look about how to build and track these specific candidates during today's session. So in terms of scanning the markets, this is built directly into your OptionsPlay platform under the watch list section. The first 6 watch lists are basically the watch lists that are in your Monday and Thursday equity research report. Every single Monday and Thursday equity research report, we give you this broad view of what's emerging, right? What's in that early breakout category? What's starting to build in terms of leadership, right? And then what has been kind of building over the last few weeks and has been in what we call confirmed leaders. These are kind of your strongest momentum names here at the moment, right? So when you log into OptionsPlay, and you go to your watch list, the first 6 watch lists, early breakout detector, building outperformance, confirmed outperformance, confirmed underperformance, building underperformance, and early breakdown are all these specific names. So as you can see, these 4 names that, sorry, if you look at this report here, today you have LNG, eBay, Melly, and then ET. That's all available to you here on OptionsPlay. And the most important thing that I tell investors to do is when you're looking at any of these specific watch lists is to sort it by relative strength, because that's going to give you an idea as far as where a stock is in that early breakout detector. So for example, right now, this is probably the lowest number of examples that we have seen in weeks. And this really speaks to the deterioration of the markets here at the moment, or at least as of yesterday's close, where very few names are outperforming. Very few names are starting to move here to the upside. There's a lot more here, breakdowns, if you will, that we're seeing here to the downside. So we only have 4 names to take a look at, but we'll take a look at those together here. What's going on? Let me just refresh my browser. That might be why I got logged out. Hmm. Excuse me. All right, looks like we might be having a little bit of an issue with our platform here at the very moment. All right, looks like I'm back in. So let me just bring this back up here. I apologize, everyone. Let me just try to get everything back up. All right, I might have to come back here to this here in a second. But the most important thing is to sort your early breakout detector stocks by early breakouts. And essentially, the relative strength ranking tells you how early or how late you are. The lower the strength, the fresher the emerging leadership, meaning stocks that are most beaten down, that are just starting to emerge here to the upside, those are the ones that have the lowest scores. So if you look at stocks like Booking or DoorDash in this particular case, these are going to be the stocks that you want to focus your attention on when you first start your research here in your mornings. And the goal there is to basically try to find those specific trade ideas that have had that early kind of turn, if you will, as early as possible. Those are the ones that have the lowest relative strength. If you have stocks that have this, strength of 9 or 10, these are stocks that sometimes have maybe already rallied and now have been taking a bit of a pause and turning sideways and just starting to break out here to the upside here again. So if you see the stocks that have a score of 8, 9, and 10, they're still technically early breakouts, meaning they're stocks that have been sitting around and been sitting sideways for a while. They've been chopping around, but now they're breaking out to new all-time highs, as opposed to, stocks that maybe have just started to turn and maybe have a big potential move here to the upside. Now, there's nothing wrong with trading stocks in the early breakout detector that have a high relative strength score. The downside to some of those names is just the fact that when you're trading stocks that are kind of breaking out to new all-time highs or 52-week highs, you may not have a real target price that you can reference as you do with the early breakouts. The early breakouts, those are stocks that have taken a bit of a dive here over the last, like I said, 3, 6, 9, 12 months, and now they're starting to turn around. And those prior highs over the last, 52 weeks are potential price targets here to the upside. If you have a stock that's breaking out to new all-time highs, you just simply don't have the same profit target. You might have to look at fundamentals. You might have to look at projections to kind of figure out what could be a price target here. Those are a little bit harder to do, but the underlying research tends to find that the best performance in the early breakout detectors happens in the stocks that have the lowest relative strength and the stocks with the highest relative strength. Essentially stocks that have been beaten down so much that the bounce potential is also very high, or stocks that are already trading at 52-week highs that have been kind of sitting sideways, that have been consolidating and now have a new leg higher here. Those from a performance perspective, tend to have the best performance here in the long run with these specific sectors. So the ones sort of in the middle are the ones that don't have, that are kind of in between, and those are sometimes a little bit harder to look at. Okay, so it looks like I've managed to get my platform back up here. So let's take a look at um, some of these trades. All right, so let's take a look at this is the early breakout detector that I've ranked by relative strength. So as you can see, I've only got 4 ideas. There's one with relative strength of 3, and the rest have 9 and 10. So let's just take a look at the ones with the 3 here. We'll zoom out a little bit. As you can see, this is why this stock is a 3, because this, now I don't know this particular stock, but this is obviously a very expensive stock, $1,700. But this was a stock that was peaked at $2,600 back in June of last year. So if you go back a year, this was a $2,600 stock. The stock has really taken a bit of a dive here over the last year or so. But if we zoom in, as you can see, the stock has sort of been trading sideways here for the last 4 months or so, and maybe it's starting to bottom here around the 1600. As you can see, over the last 4 months, it essentially hasn't moved any lower. 1600 has been a big support level here, and now it's got some early signs of showing some life here, right? And is this going to go back up to 2600? The reality is that no one knows. But what we're trying to do is to establish a small position as early as possible, because if it does start to move higher here, then let's say it gets back to 1900, breaks out above 1900, which is kind of this resistance level here, right? If we establish a small position now and the stock gets above 1900, that gives me a lot more confidence that this truly could be the bottom and that we're starting to move potentially much higher here. So what you're trying to do is establish a small position here. Maybe that trade never works out and you simply take a small loss and you move on. But if it does work out and gets up above 1900, instead of taking profits, this is where you want to add more, because now your thesis and your idea that this stock is bottoming and this stock has bottomed and it's now going to continue moving higher has now been proven correct. And this is your opportunity to now not just take profits in $1,900, maybe wait for a little bit of a pullback here, add some more. And if the stock does manage to get its back up to 2,000, 2,100, again, look at where the stock has been. It was a $2,600 stock 12 months ago. That's an opportunity not to just, not just to, if it gets back above 1900, this is not just an opportunity to take profits, but maybe see if you can, the stock gets back into 2000. If it gets back to 2000, that's certainly an opportunity to get back to 2250. If it gets back to 2250, then you have a real shot at getting to 2500. And the idea is that if you establish a small position as early as possible, you may have 1, 2, 3, maybe even 4 opportunities to add to this position before it truly ultimately gets to your long-term profit potential, which is around $2,600. And the reality of how many trade ideas will kind of reach that final destination is going to be less than 10%. That's the reality of it. But if you take every single opportunity that shows up that has that potential to do so, and you follow through on those, roughly 7-8% of trades that do have those big moves here to the upside, that's when you're going to hit home runs. And those home runs, as we've shown you in previous sessions last month, usually outweigh your losing trades by a factor of 4 to 5 times, if not even sometimes even more than that. That's the average, meaning you have trades that will even further outweigh your winning trades by maybe 7, 8, even 10 times. So if you're risking $1,000 on each trade, that could lead to be a $7,000 to $10,000 winner here on one trade idea. Think about that. How many times have you risked $1,000 a trade and turned that into a $7,000 gain? Not very often, but when it does, you want to be able to take advantage of it. And the only way to do so is if you use a process that combines how to manage winning trades with a trading signal that gives you that opportunity to add further exposure when those opportunities show up. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. We'll take a look at here at a couple of other names. eBay. This is another one that we recently just added to this position here. We initially established a small position here at around 111 because this stock, after having a really nice run from call it $80 to 120 or so, has been trading sort of sideways here over the last couple of months. And when it started to break out here above this 110 level, we established a small position here in eBay. And over the last couple of days, it's kind of moved its way back up to the all-time highs. And that was sort of our view, is that maybe this starts to break out to all-time highs, right? And if it can get back to one all-time highs and breaks out even further, this could really take off here to the upside, right? So what we did is we established a small position here in eBay initially. Um, we established a small position in eBay when it was trading at 111. We added to that position here yesterday when it was at 115, and now it's moved up to 117. And if this breaks above 118.73 again, I would add even more to that position. So it's a little different in terms of eBay because we have a strong fundamental view on this, which is why I'm willing to kind of take on this risk of maybe this gets back to all-time highs and breaks out even further, right? And this is really where you have to now rely on projections, right? So you could say the stock was calling a range bound between 105 and 120 after this big move here to the upside, and it's consolidating for a while. And if it breaks out here to the upside, I have to measure this move from 80 to call it 105 and say, how much is that going to be, right? That's about a $25 move. So it breaks out above 125. What would I project that out to be? It'd be around maybe 145, 150 here to the upside. That would be my upside target. And then I'd have to layer in the fundamentals to say, if the stock hits 150, what would be the valuation based on current expectations of revenue, current expectations of earnings? And is that a reasonable multiple for the stock to trade at, given, how fast it's growing, how profitable it is? So you kind of have to layer a few more things in when you're trading stocks at all-time highs to really validate the idea versus early breakouts. You can do it based on just technicals many times. Initially, when you're looking at trading breakouts to all-time highs, I usually will try to layer in fundamentals a little bit more because a stock trading at all-time highs, I have to chase that move now. It's a little harder to chase moves. It takes a little bit more understanding of the business to really have the confidence to chase a stock at all-time highs. So that's going to be the difference between taking a look at stocks with a strength of relative 3 versus the stocks that have a strength of 9 or 10, right? And we're starting to see some of the energy names show up here as well. I've highlighted LNG on our equity research board here. I don't know that the energy trades that are showing some leadership here right now is going to be particularly durable. Obviously, because they're only showing the strength here over the last few trading sessions as a result of what's happening in the Middle East. I think most of us long term still believe that, we're moving closer towards resolution in the Middle East rather than just a long-term conflict. And because of that, I see kind of these short-term moves here to the upside as somewhat limited in terms of how much upside there is, right? So maybe it gets up to 275, maybe 300 in kind of a dire scenario. But I think long-term, kind of rallies are really more opportunities to fade those rallies. So, you try to layer in just kind of the broader picture here. And when you look at the leadership names, as you can see, we have just a couple of energy names here in the early breakouts. You have a couple of energy names here in the building leadership, but that's about it. So it's not a particularly big theme here just at the moment, despite what's happening in the Middle East. So you're kind of looking at how broad something is also helpful in giving you an understanding as to, what is the potential of that specific theme, right? So I don't have a lot to show you here today, but we'll take a look at maybe some of the building outperformance names. We'll take a look at some of those names today. And just to kind of show you, the difference between something with a score of relative strength of 3 versus something with a score of relative strength of 10, right? So as you can see, 3, this was nearly $500 stock here in October of last year, essentially has this almost halved in value here over the last 9 months or so. And obviously over the last few days, last few weeks, call it this $300 level has been a major support and resistance level here for quite some time and just started to break out here, right? And if you want to zoom in a little bit more, you can say this maybe 310 level here has been a prior small minor resistance that we just started to break out of. We've got this big candle here today. The stock was up, I think, 12% at the open, is now trading back down to about 2% here. But, very much, big volume candle here. I think this has the potential of moving higher here from here. And again, this when you sort it by relative strength and you look at the ones with the lowest relative strength, that kind of gives you stocks that are potentially very early on that has that huge upside potential here. That's how we caught GE. That's how we've caught Micron. That's how we've caught Robinhood. That's how we've caught a lot of the trades in our portfolio that we've added to in the last few months, last few weeks. Versus taking a look at something like Arista Networks, which was also in our trade ideas recently. Arista Networks, as you can see, this is a stock that has been sort of range bound here between 150 and 180 over the last few months, just started to break out here to the upside, right? So it is still technically an early breakout, but it's an early breakout to all-time highs. And this is really where you have to have a better understanding of the business, better understanding of the fundamentals to say, can this sustain all-time highs? Can it move substantially higher from here? Are its business prospects strong where it can sustain a move beyond all-time highs? And that's really where you have to look at fundamentals to kind of also make that judgment call. So once you've defined an idea, you want to use the OptionsPlay platform to help you define a specific trade. So for example, if we go back to our eBay trade, for example, when you're trading stocks at all-time highs, you want to use strategies with limited risk. So using things like a debit spread or even a credit spread, ideally you want to use these types of strategies where the risk to reward is favorable and more importantly limited, so that if an idea does not turn out to be correct, you know exactly how much money you're risking here to the downside. And the vast majority of your trades, the reality of trading is that the vast majority of your trades will essentially be a series of small wins and small losses. And what you need to have, in addition to those small wins and small losses, is a few home runs. That's all you need, is a few home runs amongst a sea of what is essentially small wins and small losses. And that's the reality of trading. A lot of people think that, if you just find some secret indicator or some type of strategy that you don't have access to today, that if you just somehow work hard enough or learn enough that you'll find some secret strategy that's just going to print money month after month, quarter after quarter. It just doesn't work that way. The most successful traders, if you look at their accounts, you're going to see a lot of small wins, a lot of small losses, and a few big home runs. And, those big home runs come from when they follow through on a trade idea that they've proven their views to be correct, and they didn't take profits as soon as their views turned out to be correct. They added exposure to those specific names. Much harder to do than much easier said than done, but these early breakout detectors give you the best shot at being able to follow through with that specific trade. So just to kind of walk you through the mechanism of how to add, buy early is the first step. What I recommend for traders is to once you've bought a specific trade, add it to your portfolio. Because one of the things that OptionsPlay does is that we can look through all of the ideas that we generate on a given day, and we can screen it based on specific symbols in your portfolio. So if let's say you have a portfolio of stocks and some stocks have generated a new buy signal here, like Marvell Technologies, you want to know that because that's an opportunity for you to potentially add. If let's say you have a bullish position in Marvell, it's up in terms of profitability, and now is an opportunity to add to that position. You want to know when it generates a new trade idea. So if you add your positions here to the OptionsPlay platform, we'll give you an alert when you have a new brand new signal, and that is your opportunity to start adding further exposure. Now, the rule of thumb here is that you only do that if you have a profitable position. You never add to a losing position. So if you have a trade that you bought early on, you've added to the portfolio and you get a new signal, and this is a trade that you already have a profitable position on, that's when you want to add to that specific trade. And this is provided that the trade has not reached your profit target. So if it reaches your profit target, you obviously want to take off potentially all of your trades or the majority of your trades. But as long as you haven't reached your profit target and the trades are profitable, that's when you want to add more exposure on those given trades. Okay. So just a recap of what we discussed here today. It's when it comes to idea generation, it's easy to get moved by what you're seeing in the news, what you're seeing in the headlines, what you're seeing on TV, what you're seeing on social media. But I tend to find that if you have a different way of filtering through the noise, and I tend to find that the early breakout detector is my key way of filtering through the noise and sorting it based on relative strength, that gives me the opportunity to catch a move before everyone else does. And if you're able to get into a trade at the ground level before everyone else does and establish that initial position, guess what? 30, 40% of those are just not going to work out. You're going to have to accept that. And, arguably that's one of the harder things that a lot of traders struggle with is the fact that you just have to accept that 40, maybe even potentially 50% of the time, you're just flat out wrong on your ideas and your thoughts. Because there's really very few other places in our lives where we could be wrong 40% of the time and be considered really good at what we do. Our brain has a tough time managing that. There's not a lot of analogies for that. The closest one that we've talked through over the last few months is really baseball. If you're a baseball player, you have a batting average of 350, you're one of the best baseball players out there. But that also means that, 6 out of 10 times you're at bat, you're not getting on base. Trading is not too dissimilar from that. 4 out of 10 trades you should expect will just flat out be wrong. And we have a really tough time accepting that we're wrong 4 out of 10 times and that we're good at what we do. So yeah, I have to get used to that, right? And it's all about taking small positions as frequently as possible in as many opportunities as possible. A few of them will really take off. And in those few trades that really take off, you have to have the discipline of not just buying at 100, getting to 110 and taking profits, but saying buying at 110, gets up to 110, buy some more. If it gets up to 120, buy even more. By the time it gets to 130, maybe have an opportunity to buy even more before it maybe gets up to 150, right? And guess what? There will be times where you buy the stock at 110, 100, gets up to 110, buy some more at 110, goes up to 120, buy some more at 120, and the stock goes back to 100. Right? That happens, equally, and those are the ones that will turn out to be essentially a wash, right? But that's the reality of trading. If you keep putting yourself in those situations and keep following through that process, eventually a few of those names will go to 150, and in those few names that do go up to 150, you will have a winning trade that is orders of magnitude higher than every single time you have a losing trade. And that is how you reach profitability. So the early breakout detector is the key of how you follow through with the process that is on paper, easy to understand, very sometimes difficult to follow through. And when you catch trades as early as possible, that's when you have the best chance at doing so. So Getting in early gives you the room to reach your target and gives you the room to build the confidence and discipline to add more exposure rather than taking profits, and make sure that you're only doing that on profitable positions when they generate a new signal. Don't just don't just guess as to when you want to enter a secondary trade or when you want to add to a winning trade. Wait for the platform to give you that signal, and you can do that using the OptionsPlay portfolio tool. So that covers what I wanted to share with you here today. If you want to access the trade ideas, the early breakout detector, if you want to access the equity research report that gives you, not only a review of the broader markets, the specific trade ideas. I even highlight 7 trade ideas every single Monday and Thursday. So it's not just giving you the ideas and leaving it for yourself. I'm giving you 7 ideas every Monday and Thursday that I vetted myself, that I've handpicked from the list of stocks that I think are worth taking a look at. So you get a view, so you get a constant understanding of how to look through these names, how to validate through these ideas, how to think through these specific ideas. Getting the equity research report every Monday and Thursday to get that broader view, get kind of my take on the specific trade ideas. Every single day you can log into the platform and get your fresh ideas using the platform. And now with the new dashboard, which you can click on the education and resources button here at the very top, that's going to take you to our new dashboard page. And that new dashboard page will allow you to watch all of our previously recorded sessions. And we're going to be taking some time here. We're going to be taking some time here over the next few weeks to really walk you through the full dashboard here. And this dashboard will give you access to all of the previous recorded sessions. So as you can see, the Growth Lab series that we did on the 25th, the Growth Lab series that we did on the 18th, the 11th, and the 1st from last month, these education sessions that we did the 18th, the 11th, and the 4th, sorry, these education sessions, those are where you can get all of the previously recorded sessions here all in one place. A lot of you have given us your feedback here over the last few months with regards to, how do I get, a comprehensive view of all the sessions that I've recorded, whether it's market outlook sessions to give you an idea of how to start off the week, to educational sessions to teach you a process to reach profitability. This is now all available to you here in the webinar section. At the same time, we also have the new daily play and research widgets on the new dashboard. So you can see all of the trade ideas here on OptionsPlay, being able to see kind of the trade ideas from the last few days. So you can see how we've added, we had eBay here on July 1st. This was when we first added this specific position here in eBay. We sold that put vertical here. And then today we entered another trade in eBay because we're pressing our winning trades. So you can kind of see the progression of trades that we make from day to day, from week to week, that's now available to you. And the Monday and Thursday equity research reports are also available here under the research tab. So this morning's is from here, and then you can see Mondays all here in our research tab. So this is all available to you here in the new dashboard. I highly recommend that you take a look. And over the next few weeks, we're going to be going over the earnings calendar because earnings season is about to kick off. And then we'll cover the credit spread, cover call, and short put reports here, the various ways that you can find fresh trade ideas using the OptionsPlay platform. That's what we're going to be focusing our month of July on, is helping you understand how to utilize this new dashboard. With that covers what I wanted to share with you here today. Okay, good afternoon and welcome back everyone to our Growth Lab series. My name is Tony Zhang and I'm the Chief Strategist here at OptionsPlay, and we are kicking off another earnings season. And today we're going to be specifically going over the new OptionsPlay dashboard and the new earnings calendar that you'll find in that dashboard to help you find explosive options trades in the upcoming earnings season. Let's go ahead and get started. This is the second part of our series in July, focused on helping you find where your next trade comes from, and specifically trying to find emerging leadership from trades before the rest of the crowd does so. Options trading, our earnings season obviously is a highlight of the quarter, where you have about a 3 week time frame where you're going to get a lot of information coming from corporate earnings. You're going to get a lot of big moves, and with the AI industry recently under pressure, I expect this quarter is going to be one where we are going to see some big moves up and down. So we really want to talk through what tools we have in place to help you identify which stocks can make those big moves up and down and by how much, and talk a little bit about the option strategies that you can utilize for capturing those explosive moves. Now, if you're brand new to OptionsPlay and you want access to the tools that we'll be showing you today, you can find them at new.optionsplay.com/registration for a free 14-day trial, or you can point excuse me, or you can point your phone to the QR code on your screen. And I just posted that link into the chat window so that you can sign up for a free trial here at OptionsPlay. That will give you access to the tools that I'm showing you during today's session. It'll give you access to today's recording as well as slides afterwards. And you can also watch all of our previously recorded sessions on this particular series in the new dashboard that I'll be showing you today. Now, if you already have an OptionsPlay account, you can follow along live by going to dashboard.optionsplay.com. If you're already signed into your OptionsPlay account, it will take you directly into the dashboard without having to sign up. And this way, you'll be able to follow along with our sessions live today as we go along. So let's go ahead and get started. I'm going to start off with a recap of how Q1 shaped up and what our expectations here are for Q2. Q1 grew EPS at 28% year over year. This is by far the highest growth we've seen in terms of earnings in terms of S&P 500 corporate earnings since Q4 2021, which, if any of you recall, is essentially coming out of COVID. So a very low base that we were on was the last time we were able to see 28% EPS growth, and that compares to expecting the quarter at about 13%. So we started the quarter last quarter expecting S&P earnings growth to come in around 13%. We ended the quarter at 28%. That's just how big of outperformance we saw last quarter. And it really speaks to why we continue to see strength in the S&P 500 despite what has been a pretty challenging quarter from a global geopolitical perspective. Revenues grew about 11% year over year. 84% of companies beat on EPS, 81% beat on revenue. So we basically saw 4 out of 5 companies beat top and bottom line. So it was overall a really strong quarter. Now, the one thing to understand is that the outperformance, or the difference between the 13% we were expecting at the beginning of the quarter versus the 28% that we got at the end of the quarter, most of that came from the Magnificent Seven. Nearly 61% of that outperformance came from just those 7 stocks alone. So technology was the primary driver of that. And interestingly enough, those 7 companies were the ones that were largely left out in the AI rally in the last couple of months. That is now starting to see a rotation back into those names over the last couple of weeks as the semiconductor industry comes under pressure. So going into this earnings quarter so far, EPS growth is expected to grow at around 23.6%. So that's a really high growth rate expecting, and that's up from 18% at the end of March. So we expect earnings to grow faster than we did about a quarter ago. And history shows that many times the final number will come in higher than expected. So we may see another record quarter in terms of EPS growth after last quarter was one of the strongest we've seen since coming out of the COVID pandemic. Revenue numbers are expected to increase again to around 12.3%, which would be the highest we've seen since 2022. A lot of that is going to be driven by energy because of oil prices in the previous quarter. We expect the energy sector to have generated a ton of free cash flow as a result of that, and that's going to all flow through to the bottom line. Technology is the big part of that, and the only sector expecting to decline from EPS is going to be healthcare, but we'll take a look at that here in a second. So far, we've had the banks reporting earnings, which gives us some sense for how the quarter may shape up. 89% of those have beat on earnings. So um, we've seen a really strong start to the earnings season with banks not only beating on earnings, but also providing a strong guidance and outlook for the rest of the year, both for the banks as well as for the consumer. A lot of times the banks give us a read on the strength of the consumer. And excuse me. And in this particular quarter, we're seeing strength across the board, and that really is reflected in the rotation that we continue to see here in the markets over the last few weeks. Semiconductors have remained under pressure and remains further under pressure, yet the rest of the market is booming. If you look at today, NASDAQ down nearly 1%, the equal weight S&P 500 up nearly 1%. So as everyone is selling semiconductor and memory, they're essentially buying everything else across the board. So that's how we are shaping up so far heading into Q2. Now, out of the 11 sectors, 10 of them are expecting growth. The biggest ones we're expecting is going to be in energy and tech, which is not particularly surprising given the AI trade as well as the spike in oil prices. Now, we obviously expect that energy growth to contract by a substantial amount as oil prices have come down substantially since the ceasefire. Now, I will say, as the Iran war escalation seems to have started back up again, that could come back into play. And this is probably one of the most important indicators that we're paying attention to here right now, because a few weeks ago, inflation expectations have come down substantially. Our expectations of further rate hikes in 2026, we're starting to reprice that. Inflation prints this week have come in cooler than expected. Everything was heading in the right direction with the ceasefire, but with tensions in the Middle East flaring up again, is that going to cause a reinflation? Is that going to respark inflation? Is that going to bring rate hikes back on the table for 2026? If that does, that certainly puts the equity rally, or certainly puts on a substantial headwind for the equity rally. And I think that's part of why the equity markets have struggled to break out to new all-time highs at the moment. So those are some of the things that we're paying attention to here right now. Now, what I want to focus today's attention on is the new OptionsPlay dashboard. If you haven't heard over the last week or so, we've just launched a new OptionsPlay dashboard that's available to all OptionsPlay subscribers. And in that new dashboard is a earnings calendar that has been revamped specifically for options traders. So this is the new dashboard. If you want to know how to access it, you can either go directly to dashboard.optionsplay.com, or if you're on your OptionsPlay platform, you can click on the news and education resource, and that will take you directly to the dashboard. But I think the easiest way to get to it is just simply bookmark dashboard.optionsplay.com. That's going to be the future of the OptionsPlay platform. And inside the dashboard, you will see the earnings calendar. The earnings calendar, you can also expand and see a full screen of it. This way you can get the full view of it and you can see both grid and card views. This way, depending on how you like to view it, our old earnings calendar was similar to the card view, um, which will give you a sense for how the stock is performing, with either with whichever view you prefer. So one of the things that we are looking at here right now is how you can use this earnings calendar to quickly identify stocks that may potentially be making a big move in one direction or another. So the earnings calendar provides some filters that I think are really important for options traders. And the first thing that I want to take a look at here is liquidity. We'll talk about liquidity, we'll talk about directional edge, we'll talk about IV rank, we'll talk about all of these things in terms of helping you understand. But when we're looking at the new earnings calendar, there's going to be a few things that I think are really important for us to go through today. The first one is going to be the directional edge. This is our new directional indicator that combines our proprietary 1 month and 6 month trend indicator along with the relative strength indicator. Well, those two indicators provided together give you a view on the directional view of the particular stock. So we'll take a look at some of the stocks like the ones that are reporting today, like GE, Netflix, United Healthcare, and where they sit from a directional edge perspective, what we're generally looking for. We'll take a look at liquidity, we'll look at IV rank, and we'll look at expected move and how all of these help us gauge a specific name coming up for earnings and help us form a directional view. So the first thing we want to take a look at here is scanning for direction using directional edge. So you can actually filter the dashboard based on just stocks that are either strong bullish or strong bearish, and that will give you stocks that have the highest probability of making a explosive move, a directional move rather, on earnings because stocks that are strong bullish or strong bearish are stocks where the relative strength and trends are aligned with each other. So, for example, if we take a look at GE on our platform, the reason GE is showing up as a strong bull is because of the fact that the 1 month and 6 month trends are trending higher, and you have a relative strength of 8 out of 10. Or if you look at United Healthcare, you have 1 month and 6 months trends that have remained green the whole time, relative strength of 9 out of 10. So you have trends and relative strength that are reporting that are all trending in the right direction. Um, versus the um, intuitive surgical. As you can see, 1 month and 6 month trends are bearish, relative strength of 2 out of 10. So weak relative strength, bearish trends. This is what we're looking for on the bearish side. So the new earnings calendar essentially allows you to filter the earnings calendar based on just stocks that have a strong directional edge indicator. You can also look at if you want to expand out to maybe improving or deteriorating. But generally speaking, we want to, I'm sorry, you can have bullish and bearish as well. But strong bull and strong bear is generally what I would focus on when it comes to earnings, because that's going to give you stocks that have the highest chance of making a strong directional move on earnings. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. So looking at the upcoming earnings calendar, one thing to also look at here is under the time column, BMO means before market, AMC is after market close. So, for example, given today's the 16th, you have Intuitive Surgical and I'm sorry, and Netflix that are reporting after the close. Both of those have poor relative strength. Both of them have poor bearish trends. So that leads us to believe that these are stocks that could potentially be making a bearish um, move on earnings after the close here today. Looking at now, generally speaking, we don't see a lot of stocks that report earnings on Fridays or Mondays. Mondays, as we get later into the season, we do see more of it, but we do tend to see more earnings on Tuesdays, Wednesdays, Thursdays, generally speaking. So looking out the next 7 days, you can filter the earnings calendar just by stocks that are reporting today or the next 7 days or the next 30 days. You can also filter before or after market. So you can say only show me stocks that are reporting after the close. So you have a lot of different ways to sort and filter this list based on what you're looking for. But I would start my filters based on directional edge. That's a first step in finding stocks that are likely going to make explosive moves in one direction or another. The next thing we want to take a look at here is liquidity. If you're going to be trading options on these stocks, liquidity is obviously going to be a big concern of yours to be able to get in and out, especially in fast-moving markets. I would recommend that you start with looking at only stocks that are very liquid, and only when you sort of get towards the end of the season, when there are not as many names that are reporting, you might look at some somewhat liquid names if you're looking for opportunities or willing to be a little bit more speculative, but you're going to have plenty of opportunities in just very liquid names. So as you can see, these are all the stocks that are reporting in the next 7 days that have a strong directional edge and are very liquid. I've also selected stocks that are optionable, but almost all very liquid stocks are generally going to be optionable. So looking at stocks that are, that have not reported, that's Intuitive Surgical and Netflix. These are both bearish. You have Chubb and Charles Schwab on Tuesday. These are both strong bullish stocks. And you have CME Group on Wednesday. That's bearish. GE, Alphabet, IBM, AT&T, TE Connectivity, Tesla, Texas Instruments, United Rentals, Newmont, ST Microelectronics, and Union Pacific. Those are the stocks that are reporting in the next 7 days that have a strong directional view, that are very liquid and optionable. This should give you plenty of opportunities to look at. And the goal of this earnings calendar is to give you a short list of what to pay attention to, because earnings season is an incredibly busy time of the year. There is sometimes hundreds of stocks that you could potentially look at on a given day. Where do you start? Our goal is to help you narrow that down to a handful of stocks each day, so that if you're going to spend your time researching stocks, doing your homework, you better be focused on where you want to do that homework. And this earnings calendar provides you with that short list, so that if you like any of these stocks, once you do your homework, you know that there's an options that are very liquid for you to trade for that specific stock. You know that there is a strong directional view from a technical analysis perspective that aligns with your directional view. And now you have the basis for stocks that could potentially be making big moves heading into earnings. Does that make sense to everyone? Please type 2 into the chat window if that makes sense to you. Perfect. So the next thing we want to take a look at here is a new indicator that's part of our earnings calendar, which is expected move. And what we're doing is we're using the options market to price what's the option market telling us the expected move for the stock is going to be, giving us a sense for, and that's this column here over here on the right-hand side. And you have it both in the grid view as well as in
the column view. Both of them will allow you to see the expected move of a specific stock. So as you can see, GE Vernova, 13.1 expected move, Google, 8.5%, IBM, 12.5%. So the bigger the expected move, the more the options market is implying that stock can make a big move here to the upside or downside. So it's not directional in nature in terms of the expected move. It's really it's really based on the underlying options. So let's take a look at the grid view here again. So let's look at which stocks are reporting that are expecting to see some big moves here. As you can see, it's color coded. You have Intuitive Surgical, Netflix. These are all expecting big moves over 10%. You have GE, IBM, Texas Instruments, United Rentals, and ST Microelectronics. These are all the stocks that are expecting to make big moves heading into earnings. So if you're looking for stocks that can make big moves, that's really where you want to focus your attentions on for the specific upcoming earnings season. You can also filter by sector or industry if you'd like, but generally speaking, if you're only looking at very liquid names, you're only going to have a handful of stocks to take a look at on any given day. So that will help you sort and filter and come up with a short list of stocks that you want to be paying attention to heading into the earnings season. And lastly, what you want to take a look at here is IV rank, because that's going to help you choose a structure for the options trade. Generally speaking, IV rank is giving you an indication of whether options are relatively cheap or expensive. The higher the IV rank, the more expensive the options are. The lower the IV rank, the cheaper the options are. So I've created this T-chart here that'll help give you some thoughts around what type of option strategy might be suitable for your directional views. So if you have a stock that has a strong bull, but a low IV rank, that's really where you might want to consider buying some premium, like a call debit spread. But if you have a strong bull with a high IV rank, then you might consider selling premium, such as a put credit spread. And if you're looking at a strong bear with cheap options, you might want to buy a put spread. If you have a bearish spread that has high IV rank, you might consider selling a call spread. So let's take a look at the stocks in our list here. If we look at let's look at Intuitive Surgical that reports after the close here today. You have a strong bear here, but as you can see, IV rank is 100. So this is a stock that can make a big move with options that are very expensive and has a strong bear. So this is where, maybe we might want to take a look at Intuitive Surgical inside of OptionsPlay and consider looking at setting up a bearish we'll take a look at a bearish put spread. I'm sorry, bearish call spread here. So if I'm looking at selling some premium here, I might look at this August 28th 400-450 put spread here, because that's going to be the call spread here, because that's going to be a more favorable option strategy than buying a put spread, because puts are going to be fairly expensive right now. So you can use this tool to help you gauge. Same thing here for Netflix. Netflix reporting after the close. Let's take a look at Netflix. Netflix, as you can see, on a strong downward trajectory here. But because IV rank is very high, options are very expensive. You might want to consider selling some premium here in this particular case rather than buying premium. So if you select the high implied volatility button, that's going to help you automatically set up a call credit spread that's going to be bearish on Netflix heading into earnings. So this is where you can combine the power of the new earnings calendar with the tools inside of OptionsPlay to help you structure the options trade without having to pull up an options chain, without having to structure your strategy, your expiration dates, your strike prices, and then do your analytics. The tool does all, excuse me, the tool does all of the work for you so that you can just have a starting point at the very least to start doing some research. And you can make modifications if you'd like. For example, if you might say, I don't want to trade the weekly option, I'd rather trade the monthly options, converting that maybe to the August, or maybe because of earnings coming up, you might want to trade a shorter dated option. This gives you the ability to modify these structures yourself further and perhaps fine tune these strategies to the ones that you prefer. But this is really where you can find where you can structure the trade once you find a specific idea that you like from the earnings calendar. We'll go through a few more ideas or a few more structures. Let's take a look at Charles Schwab, for example. Strong bullish stock, relatively inexpensive options, or even if you look at this one here, Tesla, strong bearish stock. Options are actually very inexpensive here. Let's take a look at Tesla. So Tesla, as you can see, 1 month and 6 month trends are bearish. Relative strength is pretty poor at 3 out of 10. This is the type of stock that could potentially see an explosive move here to the downside. And because options are very inexpensive heading into earnings, I might be more inclined to simply buy a put spread here, looking at that September 390, 315 put. But given earnings, maybe I might use a shorter dated option, maybe even a 30-day option, looking at buying the at the money put, selling maybe something a one standard deviation way. Usually these are the types of trades where I'd be even willing to be a little bit more aggressive, like buying an out of the money put option, maybe a 385 or maybe even a 380. And the reason to do that is because if I'm expecting a big move here to the downside, I want to try to risk as less as possible to potentially make as much as possible. So risking $1,200 to make $3,200 if the stock tanks over the next few weeks, if earnings comes out poor, these are the types of trade structures that I generally prefer heading into earnings. If I'm going to be buying some premium, is I want to try to collect as much, I want to pay as little as possible and have as strong risk to reward as possible when I'm buying a put or call debit spread. So that's how you can quickly use the OptionsPlay platform and the new dashboard to help you find these explosive options moves, filter them so that you only find the most liquid names that have a high probability of making a big move, using that expected move indicator to give you a sense for how big of a move you can potentially expect, and then using the IV rank to help you determine what's the right option strategy for this specific earnings for that specific name. So this is all available to you in the new earnings calendar, which is available on our new dashboard at dashboard.optionsplay.com. So in a nutshell, that's what I wanted to share with you here today. Really short and sweet, but a lot of information now available to you in the earnings calendar on the new dashboard. Now, I saw a question here saying, hey, Tony, where can we find that cheat sheet for the Ivy rank buying either a debit or credit spread? So in the new dashboard, there is now a section in the new dashboard for all of our webinars. So this is really where you can look at previously recorded webinars and download the slides for each of these webinars. So once the session completes today, you'll see a new listing for today's session. And afterwards, you'll be able to click on that link to download the slides, because the cheat sheet that you're referring to is going to be embedded in the slides from today. So if you want to go back and watch our session from last week, which we covered our early breakout detector, a key indicator or key signal that we generate on a daily basis to help you find trade ideas early on, as early as possible in an overall trend. That we cover. You can watch that recording and download the slides. So all previously recorded webinars are now available to you here on the dashboard, and you can download the slides and follow along and have all the cheat sheets that are embedded in these slides available to you again on the new dashboard. So with that, let's turn this over to our Q&A section. While you type your questions into the Q&A window here at the bottom of your screen, if you're new to OptionsPlay, check and you want to check out what we discussed here today, type your questions. Go to new.optionsplay.com/registration, or you can point your phone to that QR code here on your screen. I'll post that link here into the chat window if anyone wants to sign up for that free 14-day trial and get access to the new dashboard, which includes this earnings calendar that I just showed you here today. And if you sign up next week, we're going to be covering the income reports on the dashboard. We'll cover calls, cash secured puts over the next couple of weeks to show you how you can find ideas for the wheel strategy using the new dashboard. So every single week, we're going to be focusing on idea generation for the month of July. Last week, we covered the early breakout detector. This week, we're covering the earnings calendar. And next week and the week after, we'll be reviewing the wheel strategy and the tools available to help you generate maximum income in your portfolio using the wheel strategy.
Okay, good afternoon, and welcome back to our Growth Lab series. This is week 3 of our Where Your Next Trade Comes From Growth Lab series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay, and we're going to be talking about one of the most popular option strategies, which are credit spreads. And specifically, we're going to be talking about how you can find the best setups using credit spreads using the tools that are available to you here at OptionsPlay. Now, like I said, this is the 3rd week in our Growth Lab series for the month of July, where we're discussing various ways to generate ideas using the OptionsPlay platform. And today we're going to be covering the credit spread opportunity report that is inside your dashboard, available at dashboard.optionsplay.com. Now, if you want access to the dashboard and the tools that we'll be using during today's session, that is all available to you here at OptionsPlay. If you are brand new to OptionsPlay, you can sign up for a free 14-day trial at the link here on your screen, which I will post here into the chat window. Or you can just point your phone to the QR code to get access to that 14-day free trial to see everything that we'll be showing you during today's session. That will include access to the webinar, access to previously recorded sessions, and the slides for today's session. So what we're going to cover today is a single option strategy that is arguably one of the most popular option strategies that is incredibly versatile and adaptable to various market outlooks, various market conditions, which is a credit spread. So what I'll do is I'll start off by giving just a high-level overview of a credit spread, if any of you are relatively new to this specific strategy, and why it's such a flexible and versatile strategy for a lot of different use cases, a lot of different market outlooks. So especially for those of you that are relatively new to options trading, it's a strategy that I highly recommend that you learn, especially if you're just starting out with options, to get a better sense of how to utilize these strategies consistently, because it's one of those strategies that you can use in almost all market conditions. You don't necessarily have to have a strong directional view on a specific stock or ETF. It's something that you can generally use in a lot of different market conditions. So when we talk about a credit spread, number one, it's a strategy that you can trade in either direction. So regardless of whether you're new to options, regardless of whether you have lots of experience trading stocks or options, whether you have a bullish or bearish view on a specific stock, or even potentially a neutral view on a specific stock, this is a type of strategy that you can potentially use for all of those directional views. More importantly, as an option strategy, it's one with defined risk. Now, there's lots of different option strategies that you can trade. Some of them have substantially more risk than others, but this is one where before you get into every single trade, you know exactly how much money you can potentially make versus how much money you can potentially lose. This way, you have full control over how much risk that you're taking. So if you ever find yourself in a position where you quote unquote lost too much on that last trade, this is something that you have full control over in the sense of the number of contracts that you can trade because you know exactly how much you can risk per contract. Now, what I find most interesting about this specific strategy and why it's most versatile is especially for beginners when it comes to options trading, because picking a direction and a magnitude is what beginner options traders many times struggle with. But this is really where not only does two out of the three potential positions or directions that a stock can move is going to be beneficial to you because once you get into a trade, the stock can move higher, it can move lower, or it can move sideways. And in two out of those three scenarios, a credit spread will be profitable. And not only will it be profitable, it is likely going to be will provide you full profits in two out of the three possible scenarios. So, especially for beginners where you're not used to picking, not only a direction, potentially a magnitude, this is really helpful as a starting point, as a strategy that allows you to take a mild directional view and still potentially be profitable using this type of strategy. And lastly, this is the option structure where time works in your favor. You might be new to options, you might have experience trading options, but you probably even at the be at a be as a be at a beginner level have learned that if you buy a call or buy a put option, time works against you. Time is always you're always up against the clock. In this particular case, you're doing the exact opposite. You're essentially the strategy driver of a credit spread is you're selling a call or a put. And this is really where time is working in your favor. So each day that passes, especially if the stock is not moving in the wrong direction, is going to be a day that's going to be relatively favorable for this particular strategy. So it's incredibly versatile. It's incredibly flexible, which is why it's suitable for almost all options investors, especially if you are relatively new to trading options. So what I'm going to do is I'm going to walk you through just at the very high level the structure of a credit spread. Many of you that are subscribers here at OptionsPlay, you are probably quite familiar with credit spreads, but for those of you that are relatively new, just a quick walkthrough of some of the more important um, things to understand from a construction perspective. Essentially, what you're doing is you are selling a option and then buying back another option against it. So in this particular case, let's say I have $100 stock. What you're going to do is you're going to sell a $100 put option and then buy a $95 put option against that. And what this allows you to do is profit in like I said, two out of the three possible scenarios. If the stock is currently at $100, between now and the expiration date, the stock can either move up, it can either move sideways, meaning it just stays put, or it can move lower. And in the scenario where the stock moves in the direction you expect it to, if this is a bull put spread, if the stock rises, you keep the full credit. Now, what's really interesting about this type of strategy is that if the stock doesn't move and it just stays at 100 between now and the expiration date, you still keep the full credit. Only if the stock were to break below your strike price, the lower strike price, do you experience a loss on the specific strategy. And what's even interesting is that the stock can actually move against you. But if the stock stays above the break-even price of $98, let's say at expiration the stock is at $99. So you think the stock's going to go up, it's currently at 100, but it drifts down to $99. Even in that scenario, you're still going to be profitable. So it's a strategy where you're not necessarily predicting where the stock is going to go. What you're doing is you're ruling out one direction. So stock's at 100, you're essentially saying, I don't think it's going to move much lower from here. That's all you need in order to sell a credit spread. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. Perfect. And the goal here is that once you sell a credit spread, you want for the stock to stay above the break-even price of the strategy. Now, one other really important, I think, concept to understand, because in a credit spread, you have two strike prices. You're selling one put option, you're buying another put option. There's a concept of what we call the width, which is the distance between the two strike prices. If you're selling the 100 and you're buying the 95, the distance between those two strike prices is $5. Now, what you collect in terms of income, the rest of that width is going to be your total risk. So in this $5 wide credit spread, because I'm collecting $2 because every single contract represents 100 shares, I'm going to collect a total of $200 in potential profits on this particular trade. Because the width is $5 and I've collected two, that must mean that my total risk is going to be 300. So there's a relationship between how much money you can potentially make versus how much money you can potentially lose. And it's defined by the width of the strategy. And this is going to be really important to understand as we go along in the session because what we're really looking for when we're selling credit spreads is to find credit spreads where the risk to reward is as favorable in our favor as possible given on where the options prices are. We can't control the options prices, but we can look at strategies where the risk to reward is most favorable for us. And that's really the crux of what we want to spend our time today exploring because the success of an option strategy, the probability of success, the probability of profit, it all comes down to this relationship between risk to reward. Now, many of you that have traded credit spreads, you might have found that there are certain types of credit spreads that have very high win rates. 70, 80, even 90. We even hear of traders selling credit spreads that have 95% win rates. Doesn't that sound amazing if you could win 95% of the time? Well, that's really where the trade-off here is something that we have to understand because the benefits of what we discussed with the credit spreads, the flexibility, the versatility that this strategy provides, the fact that you don't have to have a directional view, you're essentially just ruling out one directional view. There's one trade-off for all of that, which is the fact that you're going to risk more than what you can potentially make on this specific strategy. So it's a very key defining aspect of this particular trade that we have to respect, that we have to understand, that we have to ensure that it doesn't break our overall profitability. Because you're going to find in a lot of different types of credit spreads, right? I would say probably the most typical credit spread is where you're risking $2 for every $1 in potential reward. However, we tend to find that a lot of people find those higher probability of success strategies to be incredibly attractive. Why wouldn't I want to sell something that has 75% win rate versus 60% win rate or 80% win rate and 90% win rate, right? A lot of people fall into this fallacy of if I just have higher win rates, I'm going to be more profitable in the long run. But the one thing that we don't tend to um, understand so well, which is something, this is a theme that we have across the board as investors, is exponential growth. Exponential growth is something that humans have a tough time grasping how things ramp up so quickly. Because when you search for strategies that have roughly 67% win rate, you're going to, just from a an efficient market perspective, you're generally going to find credit spreads that have about a 2-to-1 risk to reward ratio. However, if let's say you start moving up the chain, you start looking for credit spreads that are out of the money, that have 75, 80, 90% win rates, what happens is that when you go from, let's say, 67 to 75% win rates, instead of risking $2 for every $1 you can potentially make, you're now risking roughly $3 for every $1 you can potentially make. Now, that doesn't seem like a huge jump from going from 67 to 75. But what happens if you go from 75 to 83? You know, from an efficient market perspective, you're now risking from $2 for every $1 you can potentially make. You're now risking $5 for every $1 you can potentially make. So going up by less than 20% win rate, you are risking more than double in terms of what you can potentially make. And if you do move this to the extreme, where you go from 67 to 90, right, which certainly is a big jump in terms of win rates, you are going from $2 of potential risk out to roughly $9 of potential risk for every single trade. And this is really where this trade starts to break down. 90% win rate sounds very good, but this is really what we call picking up pennies in front of a freight trade. Because yes, you'll win quite often, but the one trade that you lose, you're going to likely lose. And many times when you actually go out to that 90% win rate type credit spreads, you're actually risking a lot more than just $9 for every $1 you can potentially make. $9 for every $1 you potentially make assumes a an efficient market. And many times at these edges, you tend to find that those markets are not particularly efficient. The fills you're going to get at those really far out of the money put options are just not going to be particularly good. And you'll be risking not just $9 for every $1 you can potentially make. You might be risking 10, 12, $15 for every $1 you can potentially make. So yes, you're making a dollar every single week, every single month, but you just need one bad month where you're giving away 15 bucks, on one trade. So this is really where, from our perspective, whenever you are looking at credit spreads, the minimum risk to reward ratio that we look for is 2-to-1. Anything worse than 2-to-1, we find is going to be tough to be profitable in the long run. Because if you're taking on trades that have a 3-to-1 risk reward ratio, you need to be right 75% of your trades just to break even. That's a tough bar to clear on every single trade, throughout the year, to be right 75% of the time just to break even, which means that you have to be right more than 75% of the time to be profitable. That's incredibly hard to do, which is why when we look at credit spreads, we generally will try to risk no more than 2-to-1 risk reward ratio. But in reality, what we're able to do is find a lot of trades that are actually much closer to a 1.5 dollar of risk for every $1 you can potentially make, which means that you only have to be right roughly 60% of the time to break even. That's a much lower bar, much more realistic win rate to shoot for in order to be a profitable trader. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Now, here's the thing. What I'm talking about here right now is all fairly theoretical. It's based on, theoretical risk to reward and win rates. But I think what we really need to look at is some real world examples to help bring this home and help make this concrete especially for those of you if you're not familiar yet with selling credit spreads. So this is really where we have built our credit spread opportunity report. You can see it live in our dashboard. So if you go to dashboard.optionsplay.com, you have this reports explorer. And the first one is going to be the credit spread report. Again, this is available to you at dashboard.optionsplay.com. If you have a OptionsPlay account, whether you have a free trial or a paid subscription, you can go to dashboard.optionsplay.com once you're logged into OptionsPlay, and that will get you access to the credit spread opportunity report. That's what we're going to discuss during today's session. Okay. Now, if you look at this report, this is really where we are scanning the entire universe of stocks for you, and it gives you the highest yielding opportunities ranked from top to bottom. So what we're really looking at, what we're ranking it by, is this premium to width. How much premium are we collecting versus how much, what is the width of the trade? And the higher that ratio, the better the risk reward is in our favor. We're going to go through some calculations here in a second so you can see, what is the difference between the top versus worst performing strategy in terms of risk to reward, and what type of win rates do you need in order to be profitable. Essentially, the ones at the top of the list require the lowest win rates in order to be profitable in the long run. So essentially what we're saying is that we're trying to help you find an edge from an options pricing perspective, which is arguably the hardest part to do because you can't possibly screen a universe of hundreds of stocks for which ones have the best options pricing in real time and compare them across hundreds of symbols at once. It's just not possible to do, which is why we built this opportunity report. However, if you just look at options pricing alone, that gives you a relatively small edge in trading. What we do is we take a look at the directional view first. We only look for stocks that have generated a buy or sell signal today. So we're looking for stocks that have a directional edge first, looking at the signal as well as the relative strength and trends of the stock. That is what the directional edge indicator provides here at OptionsPlay. And then only when we find stocks that have a directional signal, a directional edge, and is liquid, meaning we're not bothering to look for stocks that are not liquid because what's the point in finding a credit spread that you can't get filled on? And then lastly, we rank all of those opportunities based on where you're going to get the best edge from an options trading perspective, options pricing perspective. And that is what the credit spread opportunity report does. It essentially automates all of the important things that you need to look for in an ideal credit spread, puts it into a report for you, and then ranks it from best to worst. So if you look at these stocks, if you see all of these are bull put spreads, meaning these are all stocks that have generated a bullish strategy in OptionsPlay. Now, but however, not only are these ones that have generated a bullish signal here in OptionsPlay, what we're looking for is which one of these have the best edge from an options trading perspective. And that's what Palo Alto does. Snowflake, Datadog, SE. Those are the stocks that are going to provide, it provides the highest risk, the best risk to reward from a trading perspective. So what you're doing here is you're not just screening anymore. You're presented with the best possible options, opportunities in your account at one time. So what I want to do is I want to walk you through this one by one. So number one, we're looking for stocks that have only generated a buy or sell signal. Buy signals will generate a bull put spread. Sell signals will generate a bear call spread. So there are two types of credit spreads. We didn't go over in our examples both. We only looked at the bull put spread before in our platform. I'm sorry, in our example before, but you have mirror images of each other. You have bull put spreads for bullish credit spreads, and you have bear call spreads for bearish credit spreads. They're essentially the same, but mirror images of each other depending on your directional view. So in this list here that you see here, they're all bull put spreads. These are all stocks that have generated a buy signal for today. If you scroll further down the list, you will see some sell signals that will generate that bear call spread. And again, a bull put spread is essentially betting on the stock will either rise or stay flat. and a bear call spread is betting that the stock will decline or stay flat. In two out of those three cases, this is a strategy that will be profitable. So this is really why it's so flexible and why so many traders love this, especially beginners who are not confident in their ability to choose a directional view, especially they feel that the stock's going to make a big move on. Because if you buy a call option, you need the stock to make a big move in order to be profitable. Here, you don't need that. It's a much more flexible, much more versatile strategy. Okay. Then what we're looking for are stocks that are liquid enough. So there could be 300 names that have generated a buy or sell signal. We're going to find that probably close to 80% of those, 85% of those are not particularly liquid from an options trading perspective. So we filter out 80, sometimes upwards of 90% of the signals that have generated a buy or sell signal out of the scans, because if you can't trade options on it, that's really where you're going to see where you're just not going to have a good experience, because if you're not going to be able to because you could have a great security that you like from a directional perspective, but if you can't find a great option strategy that you can get filled at, then what's the point of all of that? So filtering out by options liquidity is one of the most important things that we do here at OptionsPlay. Okay. And then lastly, once we have a directional view, once we have filtered out from a liquidity perspective, then what we do is we set up a credit spread on all of those remaining names and then rank it from top to bottom. And that's what you're seeing here on your screen. The reason that Palo Alto Networks is at the top of the list is because in a credit spread, these are all, so you can call it identical credit spreads, meaning we're using the same methodology to construct these credit spreads. As you can see, these are all 36 days to expiration. They are using the same methodology to construct the short strike versus the long strike. And Palo Alto gives me potentially nearly $1,600 worth of risk for roughly $1,900 worth, I'm sorry, $1,600 worth of potential reward for roughly $1,900 of risk. If you do the math behind that, that's risking only $1.21 for every $1 you can potentially make. So as we showed you before, most credit spreads will risk somewhere between around $2 for every $1 you can potentially make. Here, I'm only risking $1.21 for every $1 you can potentially make, which is why Palo Alto is at the top of the list. So these are all bullish stocks. These are all stocks that have generated a buy signal, but from a credit spread perspective, Palo Alto is going to give you by far the best risk reward that is also very liquid. Then we move down to Lululemon. Lululemon, one of the things, as you can see, it has from a directional perspective, a bearish tilt. So, for some of you that want to trade with the direction of the market or trend with the trend, that might not be the best trade for you. Lululemon is much more of a counter trend trade. Essentially, the stock has fallen so much, maybe it's due for a bounce, and you see that priced in the option right now. If you sold a put credit spread here on Lululemon for every for nearly $400 of potential reward, you're only risking $500, which is $1.33 in terms of, or actually, Lululemon's actually even a little better than that. It's actually closer to around $1.25. But I took this out because it's got that strong bear. I took that out for an example. We definitely use that directional edge sometimes to help you determine whether you're trading with the trend or trading against the trend. And one is not better than the other. It's just a completely different mindset of how you're screening for ideas. Trading with the trend is something that most people are comfortable with. Counter trend is not something that everyone is comfortable with, but there are a lot of counter trend traders out there that love counter trend setups because that's really where they feel that they have the most edge. They're looking for stocks where everyone is bearish on. They're looking for those bottom fishing opportunities. So Lululemon would fall into that particular category. If you look at Snowflake, for every roughly $1,300 in potential reward. You're risking $1,700. That's a risk reward of about $1.33. So as you can see, even the worst one, GEV, if you look kind of, this was the bigger list that we have here that I had, where you're risking $6,300 for $4,100 potential reward, your risk reward is still only $1.53. In this report, we do not show you any credit spreads that have a risk reward worse than 2 to 1. So you will not find a credit spread where you're risking $3 for every $1 you can potentially make. You are only going to find credit spreads where the worst risk reward is you're risking $2 for every $1 you can potentially make. So this report essentially automates everything that you're looking for, a directional view, from a liquidity perspective, and finds credit spreads that have the best yielding opportunities ranked from top to bottom that is available to you directly on the OptionsPlay platform. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. So we essentially built this so that you don't have to go hunting for ideas. The ideas are we've already done all the scanning. We've already done all the filtering. It just gives you a list that you just now have to choose from. And what you want to do is you want to choose from the best possible scenarios all the way to the way down. And the ones at the top are going to be the ones that have the best risk to reward ratio for you. Now, I know there's a couple of comments here. I'll address that here in 1 second in terms of, sort right now, if you're looking at the dashboard, why you can't sort by directional edge. I'll address that here in 1 second. But it's just a quick overview of what we discussed here today. What we're essentially doing is we're scanning the entire universe for stocks that have generated a buy or sell signal today that are liquid enough to where you can get filled on both legs, essentially at the midpoint or very close to the midpoint. And then what we're doing is we're sorting it for you where the ones with the best risk reward are at the very top, and anything under 2 to 1 gets thrown away. So most days you're going to see essentially a few dozen stocks at most on those types of strategies. You're not going to find more typically than a few dozen ideas. So we're really taking thousands of ideas down to just a handful that you can view. And then in reality, if you look at the top 10, those are really going to be the best performing possible credit spreads. And that's really where you want to spend most of your time, is in the top 10 within that credit spread opportunity report, because that's where you're going to find the best yielding opportunities. So with that covers what I wanted to share with you here today. I hope that this is helpful in giving you a better understanding with regards to, what a credit spread is, why you should be taking a look at it if you're not already using credit spreads, and more importantly, how OptionsPlay helps you surface the best possible credit spread opportunities where you have a directional edge, a options pricing edge, and you are filtering out all the stocks that are not liquid from this report and is updated for you directly on your OptionsPlay dashboard. Okay, good afternoon and welcome back everyone to our Growth Lab series. We are on week 4 of Where Does Your Next Trade Come From? My apologies, I'm having some technical issues with my camera, but let's go ahead and get started regardless. Today, what we're going to be looking at is the wheel strategy, specifically how you can get paid to buy the stocks that you're interested in owning. And once you own them, how to get paid to hold on to those specific stocks. Now, today, what we're going to do is we're going to go over the strategy at a relatively high level, look at the tools that are available to you to help you identify the specific opportunities, how you can maximize yield for your portfolio using this specific strategy, and using the platform to quickly screen for ideas. Now, this is going to be like I said, the last part in our 4-part series of showing you how you can use the OptionsPlay platform to help you find optimal trade ideas. And focusing on income strategies like the wheel strategy is what we are ending the month on for today. If you are brand new to OptionsPlay, you can sign up for what we're going to go over here today for free at new.optionsplay.com/registration for a free 14-day trial that will give you access to everything that I'll be showing you during today's session, including the dashboard, which will have the webinar recordings from today, along with the slides and the entire recording for the series. So if you missed out on week 1, 2, or 3, where we covered things like the new earnings calendar, the credit spread report, the different tools that we have available to you here at OptionsPlay to help you find opportunities in the market, regardless of how you are looking for ideas, this is all available to you here at the OptionsPlay platform. Now, if you already have an account, please log into your account and you can follow along. But if you're brand new, you can either use the link that I just sent into the chat window or point your phone to the QR code on your screen, and that will give you the ability to sign up for a 14-day free trial of the tools that I'll be showing you during today's session. So let's go ahead and get started. What I'll do is cover the wheel strategy at a very high level. This is not meant to be a deep dive into this specific strategy. I actually will be doing a deep dive for this specific strategy next month. We're going to be kicking off a beginner options strategy series for the month of August. Really looking forward to that, especially for those of you that are just getting started with options. That'll be a series catered to helping you understand the basic option strategies. And even if you are an experienced options trader, I think you'll find those sessions to be enriching, and you'll likely still learn something from those strategies, even if you are an experienced options trader. But I'll be doing a deep dive next month. Today, we're going to be talking about these strategies at a high level and focusing more on the tools that are available to help you maximize yield for these types of strategies. So the wheel strategy is actually a combination of two fairly straightforward, fairly simple option strategies, which are selling a put option and selling a call option. Those are the two types of option contracts that are available. And specifically, we're looking at selling or writing these specific contracts. Now, selling a put option gives you the ability to agree to buy the stock that you want at a lower price. And what this allows you to do is to own that specific stock cushioned by the premium or the income that you generate from selling these put options. And if those options get assigned to you, you essentially own the stock that you wanted to own with a discount from the income that you receive. And then what you try to do is you try to sell call options and get paid to hold on to that stock that you want to own. And you keep doing that until the stock gets called away or you sell that specific stock. So that completes sort of the life cycle of the wheel strategy. And it's called the wheel strategy because essentially it's a circular motion in terms of what you're doing. And you end up back at the original starting point, which is you want to buy a stock at a lower price. You want to get paid to try to buy that stock at a lower price. And then once you own that stock, you want to get paid to hold that specific stock. Now, there are obviously details of this that I'm at this stage glossing over because, like I said, this is not meant to be a deep dive of this specific strategy. We will certainly do that here during our sessions next month. But the thing I want to highlight for traders who are perhaps either thinking about this strategy or currently trading the strategy, but maybe not seeing not dedicating time and effort to trading this as a strategy for their portfolio is taking a look at the actual yield that you get on some of these types of strategies. Now, we pulled the roughly 800 or so securities that we on a daily basis screen for this specific strategy and wanted to take a look at what is the median yield that you get for these types of strategies. Because I tend to find that most traders who are not utilizing the strategy significantly underestimate how much income they can generate from the wheel strategy. And for those of you that are currently trading cover calls and cash secured puts, you're probably familiar with this already, but the average annualized yield, I'm sorry, the median analyzed annual yield on a cash secured put that we show you on the OptionsPlay platform is 56% annualized yield. It pales in comparison to anything else that you can uh that exhibits any form of yield. And this is for the stocks that you want to own. And then on the flip side, cover calls, the median annualized yield is about 10%. Now, the reason that there's such a huge difference between these two is because there's a very vast difference in terms of the methodology for these types of strategies. With short puts, your goal is to maximize yield. So we're searching for expiration dates and strike prices where we are maximizing that yield. With cover calls, yield is actually a secondary component of the specific strategy. The primary component is owning the stock and getting upside in that specific stock. So it's a different goal that we have with cover calls than we do with cash secured puts, which is why you see such a large difference between what is the average annualized yield for one strategy over the other. Yield is simply how much income you are earning on the specific strategy relative to the cash that you have to put up in order to acquire that income. So think of it like if you have to buy a bond, the principal versus the income that you receive. That's how you should be thinking about yield. And like I said, most investors who are not utilizing these strategies severely underestimate how much yield are available from the options market as a seller of put options and call options. A lot of people think of these strategies as quote unquote riskier strategies. But in reality, the yield on them is far exceeds what you might deem the risk of these particular strategies to be. So that's what we're going to take a look at here today. Okay. So let's start with the short put. Just in a quick example here, if you have a stock that's currently trading at $100 and you sell a stock, let's say a stock is trading at $105 and you sell a $100 put and you collect $3. Well, this is the type of strategy that allows you to collect income. And if the stock stays where it is, you keep the income. If the stock dips below your strike price, so if you sell a put option, if you sell a put option at $100 and the stock goes below $100, you essentially now own the stock, but you own it with a $3 discount. So instead of owning the stock at 100, you now own the stock at 97. The $3 that you earned in income goes to help you pay for that specific stock. And you get paid regardless of whether the stock rises, holds, or drifts lower. And if the put option gets assigned to you, meaning the stock is below the strike price at expiration, the premium that you receive will lower your cost basis, and you collect the income now immediately once you sell the put option, and you get the discount if the put option is put to you. So the hardest part, in my opinion, of this specific strategy is not necessarily understanding the strategy or picking the expiration dates or strike prices, but actually figuring out which stocks do you want to sell a put option on, because selling a put option commits you to owning the stock, which also means that you're committing to the downside of that stock if it materializes. So you want to be you want to sell puts on stocks that you wouldn't mind owning and are willing to take that downside risk. You don't want to just do it on any, you don't want to just sell puts on any stock. And you certainly don't want to sell puts just because it has a high amount of yield. Because, like I said, yield, while the yield might be high, what you need to understand is that you are taking on that downside risk. So you have to make sure you understand the company behind the downside risk that you're selling the put option on. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. Perfect. Okay, so what I want to show you is how you can use the OptionsPlay platform to look for the highest yielding opportunities for the stocks that you might be interested in. What I'm going to show you is how you can use the short put ideas section inside of OptionsPlay. So when you use OptionsPlay under the ideas section, you can choose short puts. And then what you can do is you can take that list and filter it down based on specific watch lists. You can use global watch lists that we have built for you, such as our undervalued stocks watch list. You can look at our outperforming stocks watch list. You can look at stocks that have upcoming earnings, or you can just create your own watch list and be able to see the stocks that matter to you inside of the stocks that are in the short puts. So what I'll do is I'll show you the OptionsPlay platform. So under the options, under the ideas section, if you go to the short puts, that will show you all of the short puts that we have screened for today. As you can see, there are 303 ideas. But what you can do is you can say, let me only look at the stocks in this specific in this specific list that are in, let's say, the outperformers. There are 39 particular stocks in the outperformers. And what I'm going to do is I'm going to organize this based on yield. What that means is that at the top of the list are the stocks that are generating the highest amount of yield. So in this particular case, XYZ block generates the highest yield of all of all cash secured puts that are in our outperforming category. So you can do this for any watch lists that you have. Either it's a watch list that you've made on your own or one of the watch lists that we update dynamically on our platform every single day. I'm going to use the outperform watch list just for today's purposes and walk you through how to utilize looking at this specific setup. So here's XYZ currently trading at $81. As you can see, this is a stock that from a charting perspective continues to be quite strong here. This was a $60 stock just back here in April, now an $80 stock. Seeing a 25% gain to the upside in the last couple of months, just recently broke out here above $80. So as you can see, you got this $80 resistance level. It's now broken out above that level, starting to form a bit of a base here. Maybe you think that this is a good base for this to continue moving higher. So this essentially gives you a short list of stocks that you might want to do a little bit more research, a little bit more digging on, and decide whether you would like to own this specific stock. So you look at XYZ, currently trading at 71. This is saying that if you sold the August 28th $79 puts, you can collect $3.98 or $398 per contract because each contract reflects 100 shares of the stock. Now, that means you have to put up $7,500 worth of cash in order to buy 100 shares of XYZ. That's your total downside risk, meaning if the stock were to go down to zero, your maximum risk is $7,502 if the stock goes to zero for your 100 shares. And in exchange for that, you're going to earn roughly $400 worth of income in 29 days. So what that means is that you're earning 5% of the cash that you are putting up in 29 days. You're not earning 5% per year. you're earning 5% in the next 29 days. That's the math, right? Imagine putting $7,500. This is not a comparison to a savings account by any means, because the risk on this is significantly higher than a savings account. But just think about the analogy, putting in $7,500 into a savings account and then walking away with $400 in extra cash at the end of 30 days. That's the way, in terms of yield, you should be thinking about this. Now, this $7,500 you're putting up has risk, because if the stock were to decline, you are taking on the same amount of risk as someone who owns 100 shares of XYZ, which is why I go back to my point, my original point. You only want to sell cash secured puts on stocks that you want to own, or stocks that you want to take on that downside risk for. And what we are trying to do with our platform is to help you identify stocks that meet different criterias that you might look for selling specific stocks, whether that's an undervalued stock or stocks that outperform in this particular market. Those are the ones that I would typically look at, to sell cash secured puts. And instead of looking at all the stocks that are available, we are sorting it for you based on yield. So looking at booking.com, it's a $191 stock. As you can see, if I sold 100 shares of that particular stock, this stock recently just broke out here above this 190 level, right? Just recently broke out. A bit of a pullback here to the support level here. Maybe you see this as a potential bounce opportunity going forward, right? So selling that 190 put requires $18,160 in cash to put on this specific trade, and you will earn $840 worth of income in the next 29 days. That's 4.63% yield in 29 days, or annualizes out to 76%. Now, we usually don't look at annualized returns for holding periods under 60 days. The metric is there to help you compare apples to apples, because sometimes you might be trading a 29-day option, sometimes you might be trading a 45-day option, or even a 60-day option. You want to be able to have one way to compare apples to apples to specific income opportunities if they are over different time frames. So that's what the annualized return is there for. I wouldn't use that as a gauge to determine how much yield you can generate throughout the year, but if you are doing this consistently year over year, that's what the metric that I was showing you here before was meant to give you a sense for. If you earn 5% this month, 4.5% the next month, what's the median yield you'll earn with this particular strategy over the year? And that happens to be roughly 56%. On this specific type of strategy. Now, like I said, once you sell this put option, three things can happen. Booking.com can be above 190. It could, really two things can happen. Booking.com could be above 190 by August 28th, or it could be below 190 on August 28th. If it's above 190, you now keep the $840 of income, and you can choose as to whether or not you want to sell another cash secured put on booking.com, or maybe you might want to sell a cash secured put on a different stock at that point. You can choose. But if the stock is below 190 at expiration, you now own 100 shares of booking.com, and you own it at a price that is essentially $190 minus $8.40, which comes out to be essentially $181.60. That would be your effective price that you would own this stock at. You don't own it at a 190. You subtract the $840 of income that you've generated, which means that you effectively own the stock at $180.60. That's the discount that you're getting from buying the stock using a cash secured put versus a limit order. And if you are buying stocks using limit orders today, this is a strategy that you might want to consider as an alternative to that, because of how much income you can generate while still taking on the same obligations as placing a limit order. When you place a limit order, what do you need to do? You need to have the cash
You have to set aside the cash to buy the stock. Your cash is locked up, meaning you can't do something else with it. And if the stock drops below the limit price, you are obligated to buy the stock at that specific price. What does that sound like? That sounds almost identical to a cash secured put. You have to set aside cash to potentially acquire the shares at a specific price. And if the stock goes below that strike price, you're obligated to buy the stock at that specific price. The difference between a limit order and a cash secured put is that a cash secured put pays you income that a limit order does not. Now, there are other differences between the two. It's not an apples to apples comparison, but at a very high level, from a conceptual perspective, you have the same obligations as a limit order, but you're not getting paid when you use a limit order. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. I saw a question here about why wouldn't you sell a further out of the money put option? Well, because with a cash secured put, there's two things that you're optimizing for. One, you want to maximize the yield as much as possible, but with a cash secured put, generally speaking, your goal is to acquire the shares. You're doing this in shares that you want to acquire. So you want to sell a cash secured put that's essentially as relatively close to the current price of the stock, so that you have a high probability of acquiring these shares. That's the goal of selling a cash secured put. And by selling a cash secured put near the current price of the stock, you have yields that are sometimes 4 or 5% in 30 days, which annualizes out to, like I said, on the median yield is about 56%. Um, you know, Even think about high yield junk bonds. You're getting nowhere near 50% yield annualized on those types of products. So this is doing it on stocks that potentially are a lot less riskier than potentially a junk bond, but getting yield that is significantly higher. Okay. I'll just take a look at one more example here. We'll look at Blackstone, $127 stock. If I were to sell that August 28th, 124 put, so a put that's a few bucks out of the money, that I would earn also $398, requiring me roughly $12,000 in cash to buy 100 shares of this stock. Over the next 30 days, I'll earn $400 on that $12,000 in cash, which is about a 3.3% yield in 29 days. Just to put that into comparison, Blackstone pays a really hefty dividend, 3.84%. So if you own 100 shares of Blackstone, you're going to earn 3.8% per year. Here, you're earning nearly that amount in just 1 month. So you're earning almost as much income from the cash secured put in 1 month as you do in the dividend that you do over the full year. And that is how big of a difference that you're going to make. So if you own 100 shares of Blackstone, you would earn $497 worth of dividend income for the year, but you would earn $400 of put income in just 30 days, under 30 days, at 29 days. That annualizes out to 50%. So all the stocks that I'm showing you here, as you can see, there are 22 stocks that are essentially in our outperform list that are in our short puts. And because they're organized for you based on annualized yield, these are all stocks that exhibit that outperformance. And we are essentially sorting it for you based on which stocks generate the most amount of yield selling cash secured puts. And this essentially ranks the ideas for you so that you are not searching through a list of 22 stocks, trying to figure out which ones you want to sell puts on. We are prioritizing which ones you want to do research on. We're saying, look at XYZ first, then Booking, then Blackstone, then Amgen. Once you find a stock that you like, that you would like to own, that's when you know that not only if you identified a great stock to potentially sell a cash secured put on,
but more importantly, you are maximizing yield of this specific strategy. That is the difference between hunting for these manually and really searching for these types of strategies versus choosing from a list. Um, this list essentially is prioritizing the factors that are important to you, but then it's ranked based on the highest yield so that you don't have to go through the full list. You just have to go through the top two, three, four names. And as soon as you find one that you like in terms of a stock, you know you're maximizing the yield opportunity for that specific strategy in your portfolio. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. Perfect. Okay, so let's talk about cover calls. So in this example, let's say I sell a cash secured put. By the expiration date, the stock is below the strike price at expiration. Now I own 100 shares of stock for every contract that I've sold. I own the stock at that discount price that we were talking about, the strike price minus the income that I received. And now I own the stock. And hopefully I own the stock because I believe that there's upside potential in this particular stock. Now, I might have a target price. I might have a specific um, holding period in mind, regardless of how long you plan on holding it. The thing about stock ownership is that ultimately we never know how long we're going to end up owning a particular stock for. Maybe it reaches our target price in a week, maybe a month, maybe a year. We don't have control over that. So while we hold on to that stock and we wait for that capital appreciation to hopefully materialize, this is really where in traditional stock ownership, the only income that you have while you hold on to a stock is the dividend income of that particular stock. And if there is a stock that doesn't pay a dividend, then the only thing you have to show is capital appreciation if that ever materializes. So what a cover call allows you to do is to start extracting income from the assets that you own in your portfolio. So the stocks and ETFs that you own in your portfolio, start extracting income from those positions in addition to the whatever dividend income you're already receiving from those particular stocks. And what we're doing is just instead of selling put options, we're just selling call options because the call option has the same risk profile as selling that cash secured put. You essentially own the stock and now you want to extract some income. And the only difference is that instead of selling put options to acquire the stock, you're now selling call options, which instead of giving you the obligation to buy the stock, now gives you the obligation to sell the stock. Because you own the stock, you can put yourself into the obligation of selling that stock without taking on any additional risk. When you're selling a put option, you are taking a risk for your portfolio because if that stock goes to zero, you have, a substantial amount of risk because you essentially have exposure to 100 shares of the stock. But because you already own the shares in a cover call, you don't take on any additional risk when you sell a cover call because you already own the stock. You're already taking on that downside risk. By selling that call option, you're not taking on any additional risk. The only thing you're doing is you're obligating yourself to sell the stock at a specific price. And just like the cash secured put, you're getting paid to take on that obligation. And remember, you own a stock because you're hoping to sell the stock in the future for a profit. So what would you traditionally do if you weren't an options trader? You would place a limit order at a higher price and hope that sometime in the future the stock rises to that limit order and you essentially have the obligation to sell the stock at a specific price. The difference is that if you place a limit order, you have the same obligations to sell the stock at a specific price, but you don't have any income to show for it. When you sell a cover call, you get paid income to take on the exact same obligation. So that's really where a cover call allows you to do the same thing. That's really where we turn to our cover call screener.
Same thing under the idea section. Instead of going to short puts, we go to cover calls. And in this particular case, what you can do is you can merge the list of stocks. As you can see, we have $282 stocks in our list here. Now, and I'm only filtering for very liquid securities here. If you can also look at somewhat liquid, as you can see that we have 843 securities in total. But let's expand that out to liquid and somewhat liquid. And what I can do is I can take that list and say, okay, out of all of those stocks, let's take a look at the stocks that I own in my portfolio, right? So for those of you that are not familiar with the OptionsPlay platform, you can construct a portfolio and add positions to your portfolio. So you can add all your stock positions to your portfolio. And what we can do is when we're selling cover calls, we can look at the stocks in your portfolio and only show you opportunities to sell cover calls for stocks that you actually own in your portfolio. So it doesn't make sense to look at all 843 opportunities because yes, Celsius Holdings will generate 80% yield on a cover call. But if I don't own the stock, I can't sell this cover call. So it doesn't make sense to look at it. I'm only going to look at stocks that I own in my portfolio. And for today, out of all the stocks that I own in my portfolio, Microsoft is going to generate the most yield. This is also the stock up 16% today. So implied volatility on this particular stock is very hefty today. This big jump here, and maybe this big jump is an opportunity to potentially look at selling the stock sometime in the future. This is saying looking at selling the September 465 cover call will generate, in this particular case, if we look at this particular strategy, it'll generate $465 worth of income. I'm sorry, $1,523 worth of income, which is about 3.46% in terms of yield over 43 days. So just to put that into context, if you own 100 shares of Microsoft, you're getting paid $356 per year in dividend income, right? For every 100 shares, you're earning this might be a quarterly dividend. Yeah, you are earning $356 per year for every 100 shares of stock that you own. Here, you're earning $1,523 of income in 43 days by selling a cover call. So you're essentially earning a cover call that's nearly 5 times the dividend yield that you get per year, but you're earning that in just 43 days. That's how big of a difference in terms of income you are getting from a cover call versus the dividend yield. Just to help put these things into context, because like I said, this is really where I think a lot of traders, a lot of investors severely underestimate how much potential income is available in these specific strategies. Now, you might say to me, I'm not willing to sell Microsoft stock at 465. I'm more interested in selling at maybe at 500. Well, this is really where you can make those modifications to say, okay, what happens if I go out to September and I want to go up to 495 or 500? You can fine tune these specific strategies and see. So, for example, if I sold the September $500 calls, so I'm saying, you know what, I think this thing can go higher. I think it can go 500, maybe even 550, right? How much income can I still generate? So here you can generate $620 worth of income over the next 50 days, which is still nearly double the annual dividend income you are earning in just 50 days. That annualizes out to 10%, which is, like I said, based on the cover call data that we have, is probably the average income that you will receive from one of the trades that we set up inside of OptionsPlay. Let's take a look at another stock. Let's look at ExxonMobil, right? And I'm using ExxonMobil because this is a stock that pays a higher dividend yield.
maybe you're owning the stock and because of, what's currently going on in Iran, this might not be the type of long-term holding that you are looking for. You're just holding it in the short run and you're looking to generate as much yield as possible in the short run for it. Selling that September 167 and a half puts, I'm sorry, 167 and a half calls, which are essentially selling calls near the peak from March, right? You're essentially selling it at that peak. So you're basically saying if it gets back towards that peak, I'm willing to sell this particular stock. And in the meantime, I can generate $233 worth of income in just 43 days. Compare that to the $400 in income that I earn per year holding on to this stock. Now, the ExxonMobil arguably is a stock that pays a pretty decent dividend, 2.6%. So if I have 100 shares of the stock, I'll earn $400 per year. Here, I'm going to collect about half of that in just 43 days. That's how much income that I can generate from a cover call on ExxonMobil. And it obligates me that if the stock rallies back above or, to the prior peak in March, that will be the trigger that allows me to sell the stock while earning that specific income. Not a bad outcome from my perspective. We'll take a look at one last example here in Amazon. Amazon stock selling off a little bit here over the last couple of weeks, kind of formed this double bottom around 225. Maybe you're looking for a little bit of a bounce here. This is looking at selling a 275 call, essentially getting back to again those May peaks, right? If it gets back above 275, you're saying I'd be comfortable selling the stock at 275. Here, as you can see, if I were to sell this, I would earn $325 worth of income for every 100 shares of stock that I own on a stock that pays zero dividends. So that annualizes to 12.34%. I'm earning essentially $325 over the next 43 days. Now, you can always choose to be more aggressive. You can choose to be shorter dated, longer dated. You can make that choice and see kind of how that affects the amount of income that you can potentially generate. But that's what this tool is designed to help you do, which is maximize the income potential for this specific strategy in your portfolio for the stocks that you want to buy and for the stocks that you own in your portfolio that you can generate yield on that portfolio, making sure that you are looking at the top yielding opportunities every single time you're doing this analysis. You're not doing this in alphabetical order. You're not doing it based on which positions have the most gains or losses. You're doing it where you're going to generate the most yield, which is going to save you hours and hours of time from researching these specific opportunities across the 19 stocks that you own and prioritizing the ones where you can generate the most yield at the top of your list. So again, what we want to do is avoid searching for opportunities, but actually rather just choosing from the top performing strategies. That's our goal here at OptionsPlay, is to help prioritize what you research and what you're looking at so that you're choosing and not searching. Searching is a frustrating experience for anyone who's traded options for any period of time. If you're just searching for ideas or searching for opportunities, you are constantly hitting dead ends. It's a huge mental load on your mental capacity. And many times when we're just searching for ideas, by the time we find one, we're mentally fatigued and we don't necessarily follow through with the best practices by the time we're actually executing those trades. Instead, what we want you to do is we will do the work and you just pick from the top performing strategies, the ones that make sense for your portfolio. Does that make sense? Please type 1 into the chat window if that makes sense to you. Perfect. So just to reiterate what we went over today, the platform will help run you through the entire loop. The wheel strategy is what generates income to allow you to buy and sell the stocks and ETFs that you want to own. You sell by selling short puts,
Look at undervalued, look at outperforming, look at the earnings watch list, or just create your own watch list. That will allow you to search for the best opportunities to sell put options for the stocks that you love. If and when those short puts get assigned, you now own those stocks at a discount, many times a significant discount, a discount, a factor that most investors underestimate. And then once you own that particular stock, you want to start selling cover calls and keep doing that until the stock gets called away. Once the stock gets called away and you have cash in your account, you essentially take it and you roll it all the way back in the beginning. That's why we call it the wheel strategy. You're just going around in circles. It's a repeatable income strategy for stock investors. It is not for options traders. It's not for people who necessarily have a strong options background. If you are currently buying and selling stocks and ETFs in your portfolio, you are likely underestimating how much income you could be adding to that portfolio by using these mechanisms to enter and exit your trades rather than limit orders. So that covers what I wanted to share with you here today. Once again, what I will do is open this up for Q&A, but before I do, if you are new to OptionsPlay, you want access to the tools that I'm showing you during today's session, you can get access to it either by pointing your phone to the QR code on your screen or going to the link here that I've highlighted on the right-hand side, new.optionsplay.com/registration, which I just posted into the chat window for this session.